weakness most traders carry into the market is the urge to act before the market has confirmed anything. They feel a small movement, a minor uptick, a sudden drop, or a candle that looks different from the last few, and they convince themselves that this is the beginning of a trend. They want to believe they see something others do not. Yet the market rarely rewards those who try to predict its intentions. It rewards only those who wait long enough to let it reveal the truth. Acting without confirmation is not a strategy, it is impatience disguised as confidence. And impatience is the most expensive emotion in speculation. When a trader enters too early, he is essentially trying to impose his will on the market. He believes his analysis is strong enough to force reality to align with it. But markets do not bend for anyone. They unfold on their own schedule, at their own pace, indifferent to the hopes, excitement, or certainty of any individual. A trader who guesses is simply volunteering to become liquidity for someone more disciplined. The moment he enters without evidence, he becomes vulnerable to every minor fluctuation. He begins to justify staying in the trade even when the market clearly disagrees. What started as impatience quickly turns into stubbornness, and stubbornness turns into loss. Waiting for confirmation is more than a technique, it is a mindset. It means you accept that you are not smarter than the market, and that your first job is not to predict but to observe. A market often moves in ways specifically designed to mislead those who react too quickly. A sudden breakout may attract buyers, only to reverse and trap them. A sharp drop may scare weak hands into selling, just before a major rally begins. The market's natural rhythm is built on testing conviction. Those who jump at the first sign of movement are the easiest to shake out. But the trader who waits for confirmation, who demands proof that the move is real and not a trap, avoids these costly shakeouts. Confirmation comes in different forms depending on style, but the principle is the same. It might be a higher high and higher low forming in sequence, a break followed by a retest, sustained volume behind a move, or price holding above a key level rather than merely touching it. Whatever the method, confirmation is the moment when the market validates your idea instead of contradicting it. Entering after confirmation may sometimes mean missing the first part of a move. But missing the beginning is far better than being on the wrong side of a false start. Professionals know that safety is more valuable than early entry. The crowd wants to be first, the disciplined trader wants to be right. The difference between guessing and waiting is the difference between emotional trading and strategic trading. Guessing feeds the desire for excitement. Waiting strengthens the ability to see clearly. A trader who waits for confirmation is not seeking action, he is seeking accuracy. He is not chasing the market, he is allowing the market to come to him. When the market finally does confirm the direction, the move tends to be stronger, more reliable, and less stressful. A confirmed trade flows in harmony with the trend instead of fighting against uncertainty. It becomes easier to hold, easier to manage, and more profitable in the long run. Most traders fail not because they lack intelligence or tools, but because they trade based on what they hope will happen instead of what the market has proven. Confirmation is the barrier between professionalism and loss. Those who ignore it pay dearly. Those who respect it survive long enough to profit from the opportunities that matter. Many traders enter the market believing that avoiding losses is the goal, but the reality is very different. Losses are woven into the fabric of trading itself. What destroys accounts is not the presence of losses but the refusal to accept them when they are small. The market always gives a trader a moment, a tiny window where the loss is manageable, controlled, almost insignificant. But the ego steps in, whispering that the trade will come back, that this loss is temporary, that closing the position now would be an admission of failure. This mindset is the true enemy. the small, harmless loss that could have been taken early grows into something large, dangerous, and emotionally draining. The trader did not lose because his analysis was wrong, he lost because his ego did not allow him to respond correctly. A small loss is nothing more than the cost of doing business. Professionals understand this deeply. They treat every small loss as tuition, a fee they pay for information. When the market moves against them right away, it is not a personal insult or a declaration of incompetence, it is simply the market's way of saying, this idea is not valid. A wise trader listens. He accepts the message immediately and steps aside. This ability to surrender quickly is not weakness, it is strength. It shows the trader values survival over pride, longevity over being right in the moment. The market punishes those who cling to their opinions more than those who adapt. Ego builds narratives that keep traders trapped. After entering a position, the ego becomes invested in the idea of being correct. It becomes painful to admit that the initial judgment might have been flawed. Instead of responding to the price action, the most honest voice in the market, the trader argues with it. He adds more to the position, hoping to lower the average. He widens the stop loss, telling himself he just needs a little more room. He shifts from strategy to justification. Each decision is fueled by emotion rather than logic. The longer he waits, the more emotional the situation becomes, and emotional trading is always expensive. A trader who cuts a small loss early retains clarity. He preserves mental energy for the next opportunity. He remains calm and objective. But a trader who lets a small loss turn into a large one experiences a different reality entirely. He becomes consumed by fear, unable to think clearly. He stops following his plan and starts reacting to his own stress. His decisions become irrational, doubling down, exiting too late, or freezing entirely. When the loss finally becomes too painful to endure, he closes the trade at the worst possible moment, not because it was strategic, but because he could no longer bear the emotional weight. The key truth is that the market does not punish small losses, it punishes refusal. It punishes hesitation, stubbornness, and the need to be right. A professional trader knows that taking a small loss is an act of respect toward the market. It is an acknowledgement that the market's message is more important than personal opinion. This humility protects capital, and more importantly, it protects the trader's mindset. With capital preserved and emotions intact, the trader remains ready for the next valid opportunity. A small loss does not damage confidence, it strengthens discipline. On the other hand, large losses break traders not just financially, but psychologically. They introduce doubt, fear, and hesitation into future trades. They cause traders to miss the best opportunities because they are still recovering from the heavy blow dealt by ego-driven decisions. This is why those who embrace small losses grow stronger, while those who avoid them eventually crumble. The ability to cut a losing trade without hesitation is the dividing line between those who survive in the market and those who disappear. A trader who accepts small losses as a natural part of the process ultimately finds greater consistency and peace in his trading, while those who let